All right, hello guys, everyone. Welcome to Never Give Up podcast. We got episode 4 here. We got a big crew here today. We got guests. We have John. We're going to talk a lot about mortgages, a lot about building legacy and finances. John's an expert in the field. Give you a quick intro right now.
John, talk about yourself. Brag about
Yes,
yourself,
brag.
John.
This man is top tier, number one right here.
Thank you, guys. I'm a very humble person, but I like to exemplify, what I've done for the last 18 years. So I have 18 years of mortgage experience, 20 years of real estate experience, and 5 years of Wall Street experience. I'm the president of Team John, which is a team of 10 people. It's me and 9 people that work for me in various different roles. But I'm also the vice president of Madison Mortgage, where we're the number one mortgage broker in the whole state of New York. And me officially, I think I'm ranked number 3. In 2020, I was ranked number 1 loan officer in New York. 2021, I was ranked number 3. This year, I'm also going to be probably ranked number 3 in case I get to the number 2 spot. I'm going to try. But my passion is helping people. My passion is servicing and helping people. That's what I love to do. I don't look at a transaction as what's the commission? How much am I going to make? Can I make a couple of points, 1 point? No, it's how can I help these people? How can I get them the best mortgage, the best program, the lowest rate, the lowest closing cost? And that's my approach. And that's the reason why 99% of my business is all referral, right? If you love what you do, you never have to work a day in your life.
Now, John, I heard a lot of mortgage people, and I'm around a lot of mortgage people the last 20 plus years. You're the only guy that said I get you the lowest interest rate. Now, that's kind of mind-boggling. When I first heard that, I'm like, this guy's what? No, he's not really doing that. Until I started experiencing with clients that I gave you and we as a team, and like, this guy's legit. I just sent you my brother too as well. I'm like, go to this guy. Go to this guy. Right? Because people can't say that. People can't say that in this industry. I don't want you to give you a secret, but whatever you feel. I mean, this is a podcast where we say never give up, and then people got to level up to this stuff. But people don't, especially in the mortgage industry, what's happening right now. I think we're in November, guys. People are flocking, dropping out, flies are going, people are laying off 20% here, 20% there. How are you sustaining, before we get into the whole podcast, how are you sustaining your mortgage industry? And you're saying you're number 3 and also able to offer the lowest interest rate. And I think that's really important right now too as well.
Yeah, well, thank you for that. So it's really no secret. The reason why I'm very busy and overwhelmed, I mean, I'm looking at my cell phone right now. I have 170 text messages I got to go through later, 800 emails. This morning, I spent 4 hours at the Sheraton Hotel by LaGuardia Airport. I attended a seminar. Mostly real estate agents were there, a couple of guest speakers from Houlihan's, Lawrence, whatever the case may be, and like 5-6 loan officers from 6 mortgage lenders. When the loan officers were kind of speaking to the real estate agents, they were like, oh yeah, rates are in the 7s and the 7s. I said, I raised my hand. I'm like, I'm sorry. I can't agree with these loan officers. And everybody looked at me in the whole room. And I said, I'm sorry, but my rates are in the 6s for conventional. I'm in the 5s on FHA and VA. The loan officers were like, wait, how could that be? Are you serious? I'm like, of course I'm serious. I'm not going to embarrass myself in front of 150 people in the room. And this is being recorded. So I'm telling you right now that I'm locking loans at 5s in the government rates, 6s in the conventional rates, right? And the reason is because 18 years I've been in the mortgage industry. The first 14 years, guys, I was only privy to the retail sector, the retail rates, the retail mortgage banking. I was so proud actually that when I used to walk into a meeting and I was introduced as, oh, here's the mortgage broker, John. I'm like, no, I'm not a mortgage broker. I'm a mortgage banker. I really wore that on my sleeve. I was so proud of it. But I had this ignorance that I didn't know about the mortgage broker side, the wholesale channel. So any loan officer that's going to listen to this podcast, listen up. As a retail lender, being top 10, top 5, top 3, and all those companies I worked at and for those 14 years, I was always closing just enough loans, like 50, 60, 75, never more than 75 at any given year working in retail, because it was so difficult to work in that market with the approvals with 20 conditions, high interest rates, high closing costs, and the process dragged around forever, no matter how hard I tried. 4 years ago, I experimented with the mortgage broker channel where we work in wholesale. And I saw how low the interest rates were, how fast the process was, and what the technology and the rates were so low. I said, how could I lose? Now I understand 14 years in retail, I used to lose a lot of clients.
I'm going to stop you. I'm going to act like a dummy individual. And because this is for, we want to educate, right? And you said it so importantly, like we want to educate, you want to service. I don't know what retail means, man. What is retail?
So the mortgage industry industry is really divided into two different sections, right? You have retail, wholesale. Retail is banks, regular banks, credit unions, where the customer goes directly to those banks. Retail is also direct lenders, those mortgage companies that you all know and well aware of. I don't want to mention any names, but they're just do mortgages. They don't do anything else, just mortgage. Those are mortgage lenders, right? So the retail means the customer goes to them directly. They're getting a retail interest rate, and retail versus wholesale, retail is always higher, right, guys? Why is Beef Wholesale Club and Costco wholesale supermarkets so successful? Because as a customer, you go there and you're buying in bulk, right? So Rummy goes to rocketmortgage.com and he's getting 7.125 on a retail 30-year fixed rate. And then Rummy's like, wait a minute, John has an account with Rocket Mortgage. Let me just go to John. But John is Madison Mortgage, not Rocket Mortgage. I have an account, a wholesale account with Rocket Mortgage. I call Rocket. I'm like, hey, I got my VIP realtor Rummy. He's buying a house for himself. I need the best rate. Okay, for him, 6.5. So if you go to Rocket Mortgage directly, Rummy, you're getting 7.125 retail. I'm getting you a mortgage with the same lender, but I'm using their wholesale channel and I'm getting you a discounted interest rate. Now, most banks in the country do not offer wholesale and retail. I would say about a good 400 companies in America do offer both, right? Like Rocket Mortgage, they have retail and wholesale. Caliber, HomePoint, HomeBridge, Cardinal. These are all companies you heard of. They have the retail channel and they have the wholesale channel. So because I'm a third-party independent mortgage broker with access to all these lenders, I'm dealing in wholesale. What does that do? The customer gets savings. Now, Rummy, to circle back on your point about educating, here's the why. Here's the mechanics behind it all. As a mortgage broker, a loan officer commission as a mortgage broker is a lot smaller per file than a mortgage lender, where the margin is huge, right? The reason why those rates are high for regular lenders and retail, because a lot of margin. Margin is the lender's profitability, right? Whereas the mortgage broker, we're limited to 2.75% commission. So that's why our rates are so much lower. And if I reduce that commission or eliminate it completely, the rates are even lower.
Wow. We need a fifth podcast.
Yes.
We need a number 5 right now. I think we got to go to number 5, guys. Here's your mortgage expert right now. He just broke down the whole process. And I think because as an investor and building your wealth and through never giving up, guys, you need to understand these little, I would say it's so small. Like I wouldn't know that if I wasn't experienced in the industry. And I know the industry changed in 2007. A lot of people don't want to become a broker. They're like, oh, direct lender. But now all of a sudden this is coming back. And that little 1%, I'm not saying how many percentage, first of all, sorry, 0.25%, whatever. It's going to help you build that wealth. It's going to help you build that legacy or whatever you're building to buy your first house. So make sure, guys, you get an expert like John that is sitting back, understanding the whole process, giving you the best rate. Again, like I said, I'm telling you, 22 years in this business, I never heard anybody say, I'm going to give you the best rate. And he just explained what it was. Thank you for the explanation. And I think that gives you credibility on, hey, what we could do in helping the community out there as we move forward. So John, the last podcast, again, this might be podcast number 5. We don't know yet, but the last podcast that we did on number 3 was really helping investors out there, first-time investors with a 3.5% down, FHA loans. How do we build a legacy where they could buy a 4, 3, 2, and 1? Now we give our point of view. We always said guidelines, because we don't know the guidelines, right? And that's why we want to kind of bring you in and kind of give you your expertise, guys. This is what you need to wait for. Now, first of all, can it be done? Can I buy an FHA 4, 3, 2, 1? Second, what do you expect on how to move forward? How long that has to be, and a PMI, I know we talked about that too as well. So kind of dive into that and really explaining. Let's go with the 4-family house. I'm going to take George. Let's take George an example. He's 26 years old, makes, I don't know, $100,000. Can he use a rental income? So break that down for us and explain that in a very symptomatic way so people can kind of grasp it. I know you will, and apply that with the right lender, with the right realtor too as well.
Perfect. Thank you. So let me start with the single family. For everybody who's listening or watching this podcast right now or in the future, with respect to a 1-family home, a condo, or a co-op, you always want to advise the customer or the buyer, in your case, to go with a conventional loan. Why? Because if you look at the minimum down payment amount for a conventional loan on a single unit residence and the minimum down payment on FHA for a single unit residence, they're almost identical, right? FHA has a minimum down payment of 3.5% of the purchase price. Conventional first time home buyers, they have a minimum down payment of 3%, which is lower than FHA on single unit. What is a single unit residence? Condos, co-ops, and one family home where people can just one family live, right? That's a one unit, legal one unit. Now, the advantage why everybody should look at FHA, understand FHA, and select FHA is with the multifamily properties. Why? Because the down payment on a multifamily goes from 3.5 on FHA to 15% on a conventional loan. That's a big jump, right? I know most of our clients are blue collar workers, right? Nobody has $125,000 in the bank to throw 15% on a two family house in Mount Vernon, right?
True.
So that is the reason why when it comes to multifamily property, the upper hand is FHA all the way. So let's talk about multifamily. Multifamily is in the residential market, 2, 3, and 4 unit properties. And on a case by case, like it is with your colleague and team member Eder Aldana, we closed a buyer that did a mixed use property as an FHA transaction. So 2 unit, 3 unit, 4 unit, and mixed use are all considered multifamily FHA, and they all carry a minimum down payment of 3.5%. In case you were curious, 2 family conventional, your minimum is 15% down. 3 family and 4 family conventional, 20% down. That's why every buyer should be looking at the FHA for affordability and not having to cough up $100,000 for down payment, just for down payment, right? So now, you want to instruct your buyers, especially their first-time home buyers. Like, for example, look, there's 2 kinds of buyers. Buyers that are ambitious and want to own 3, 4, 5 properties in the next 10, 15 years. And you got the buyer like, no, I got my wife, my kid, and my dog. I just want the fence, the mailbox, the single-family house. I don't want to own any property. My parents were landlords. They hated it. I hate landlords. I never want to own another property again. Maybe that's somebody you don't try to convince to a 2-family house. Okay, I'll find you a 1-family, you go conventional, end of story. For your other buyers that have the ambition and the desire to get multifamily properties, not 1 or 2, but 3, 4, 5 in their portfolio, you want to always instruct them, reach for the top, right? Go after the 4, the 3 unit properties and maximize your rental income. But you got to remind your buyers that, hey, remember this is an FHA product. It's a federal mortgage loan, right? It's a federal mortgage program, which means you have to live in the property as your primary residence. Now, I'll put a little star next to that because here's what I'm about to explain. I've had buyers that were FHA buying a 2, 3, or 4 family property, but they were single, no kids, maybe a girlfriend or fiance, but no dependents, no children. And they said, why would I occupy the first floor and have 3 bedrooms or the second and third floor with 2 bedrooms when I could live in a basement? It's fully furnished. The seller's an investor. It's a flip house, right? So they could live in the basement while they collect the 3 rents on top on the 3-family house. Now they live for free. The property pays for itself. And the buyer has tremendous cash flow. I've had so many buyers do that. Remember, FHA just needs you to live in the property, minimum 1 year. They don't care where in the property you live. You could live in the basement. You could live in the backyard in a treehouse. You could live in the attic with the raccoons. FHA don't care.
Go live in the raccoons, guys. Go live in the raccoons.
Snuggle with them.
I thought about it.
So this is awesome, guys. This is exactly where if you get focused on getting the right people around you, and also you get focused on getting the data in front of you, that's really relevant. And I haven't heard a lot of people talk about this. Everybody want to do this because I know when I first got into the real estate, like, oh, do this, and do 4 and 3. So let's go focus back on. So you got a 4-family house, right? I got the basement, fine. Now, can I utilize? I don't make enough income, right? I make $40,000-$50,000. Can I utilize the income from the rental, and how much? What's the credit score looks like? Income look like? Moving condition? I know that with the FHA. How long I have to live there? And then can I move to a 3-family after that when I purchase it? And how long I have to live there too as well?
So the FHA program requires that the buyer live in a property at least 1 year, right? Because they're a primary residence. After that, you could leave and go wherever you want. Ideally, you don't want to get the second home until you have built enough equity in that 4-family family to do a refinance and take it out of the FHA loan and put a conventional loan there to eliminate the PMI. All right. Now, to Rami's point, yes, FHA allows the consumer, the buyer, to use the rental income of the second, third, and fourth floor if it's a 4-unit property, right? FHA is always going to advise and encourage underwriters that are FHA licensed to do FHA loans, always put the underwriter buyer on the first floor, right? So unit 1 always goes to the owner. It's the superior unit, right? First floor, you got the basement, they got the side door, the back door, the front door, right? The tenant units are usually second floor, third floor, fourth floor. So on a mortgage application, a buyer makes $50,000, but they want to qualify for the 4-family for $700,000. They can use the proposed rental income, and it's market rent, not what the seller. Because remember, the seller probably is renting out the second floor to a cousin, third floor to his aunt, and fourth floor to an old lady he feels bad about. So he might be undercharging rents. FHA doesn't care about that. They care about what is the appraiser going to put in the appraisal report. So what is the maximum rental income? Let's say 2,000 second floor, 2,000 third floor, and 2,000 fourth floor. Now the buyer can use up to $6,000 in additional income to go on the mortgage application. But because he's a buyer that doesn't own the property yet, we have to calculate the $6,000 in rental income for those 3 units multiplied by 75%, which is the vacancy factor. So 6,000.
So it's not 80%. It's
No.
75%.
75%. That's $4,500, guys. So 45 times 12, that's an additional $54,000 to the buyer that Rami was talking about that makes $50,000. Now that buyer makes $104,000 for qualification purposes.
Wow, that's
right.
Yeah.
Here is a little bit of caveat with FHA loans. When it comes to 3-unit and 4-unit FHA transactions, 2 very important guidelines to remember. And it's only 2, so you guys will, if I say it now, you'll remember forever. And it only applies on FHA 3 to 4-unit transactions, purchase or refi. Number 1, the property must be self-sufficient. Self-sufficient. What does that mean? That means that it has to sustain itself. Whatever the mortgage payment is, it has to sustain itself. And for that formula, you use all 4 apartments, right? So let's say each floor is $2,000. That's $8,000, right, guys?
Mm-hmm.
Yeah.
Mm-hmm.
So $8,000 multiplied by 75%. That's $6,000. The mortgage payment of the buyer cannot exceed $6,000, including property tax, home insurance, PMI, if applicable, flood insurance, if applicable, HOA fee. I've seen some HOA fees on multifamily, guys. So I have to say it. So as long as the total monthly housing expense is $6,000 or less, FHA considers the property self-sufficient, right? That's why it is critical. I closed 2 deals this year alone. 2 deals that were both FHA 3 and 4 family properties, one in New Jersey, one in upstate New York, where the appraisals came in short, not the value. The value came in, the appraiser got the value perfect, but the rental income came in short and the property didn't pass the self-sufficiency test. I took those files over. I ordered a brand new appraisal. The appraisal company saw the targets and they got it done. And they maximized the rental income for each floor. And we were able to close those transactions and the properties did pass self-sufficiency. So that's a huge one. With these rates being so high, it is critical that you select a lender that can give your buyer the lowest interest rate, because the lower the rate, the lower the mortgage payment, the easier it's going to be to pass the self-sufficiency test. Okay? That's one of the biggest killers of 3 and 4 family transactions, right?
Self-sufficiency. So let me just repeat that again, guys. So if you have a 4-family house that you have 2,000, that's about almost $8,000 monthly, right? 4-family house. You're including your unit that you're going to be living in, right?
Correct. You include for that formula, yes.
Yes. Now your mortgage, taxes, insurance, flood, HOA cannot exceed more than $8,000 per month.
Well, no, 8,000 times 75%. The vacancy
Which is
factor.
6,000.
Yes, the vacancy.
Right.
They can
Okay.
the 6,000.
Okay. I didn't take that in consideration. Really good information. Now, let's just say George got his 4-family house now. He lives there for a year. What is the guideline now? He wants to, can he use the same FHA or does he have to refinance and now get a what? Or can he use another FHA? Hmm?
The second guideline that you guys need to know about as
Sorry, go ahead.
agents is the that every buyer that purchases a 3 or 4 unit property with the FHA program, they must have minimum 3 months reserves. So they got to have the 3.5% down payment.
Mm-hmm.
They got to have the closing cost or have a seller concession built in, but they got to have 3 months reserves. What does reserves mean in the mortgage industry? It means that whatever the mortgage payment is, FHA needs the buyer to demonstrate and show that they got 3 mortgage payments in reserves. The good part about it is that it's only 3 months and reserves cannot be gifted. So let's say your buyer's like, I got the down payment, I got the closing cost, but what do I do with the reserves? Well, get creative. If you have money for closing costs,
We like creative, John.
get a gift for the reserves, but we're not going to call it a gift for the reserve. We're going to call it a gift for the down payment or a gift for closing costs. And the money you already had, we're going to say that's the reserves.
There you go, buddy. There
That's
you go.
good, yeah.
There you go.
Creativity.
Gotta get creative. But
Hallelujah, right there. So reserves, guys, reserves, 3 months reserves. You got to have that. And then, you know, one of the tactics that you could use is to get a gifted closing cost, right, John? It doesn't matter.
Remember,
Down payment, no closing costs, right?
Yep. FHA allows gifts to be used towards down payment and or closing cost
Okay, that's good to know.
Yeah. So you just save that money, leave it in your account. And you need 3 months bank statement to making sure it's been there, correct?
Yep.
Okay, awesome. All right. So George got his 4-family house.
Yeah.
1 year passed by. He wants to use his FHA and he wants to buy a 3. Can he buy another 4-family or he has to downgrade to
So you can't really have 2 FHA loans at the same time.
Okay.
You kind of can, but you got to demonstrate the reason why. Like, did you do a job relocation? Did your family get bigger and you got to move to a bigger unit? Did you move out of state and now you're forced to find a job in New Jersey as opposed to Westchester County? Like, there has to be valid reasons on why you got to get another FHA loan, which is the reason why once you're in that 4-family, and remember, multifamily properties appreciate in value a lot more than single family homes because they're more desirable, right, guys? So George's 4-family that he buys today is going to appreciate in value, right, over the next couple of years, hopefully. So the more equity you have, the easier it'll be to refinance from FHA to conventional. Once you pay off the FHA loan and you have a conventional on your 4-family and you allow 6 months to go by or a year to go by, you're free to get another FHA loan on a 3-family, assuming you're going to live there as your primary residence.
Got it.
Right.
Got it.
Question.
Awesome.
So if let's say the 4-family and the 3-family is right next to each other, can they happen or it has to be a little bit farther apart?
It's not really a black and white answer. It's up to the underwriter's discretion, but it's really all how the loan is structured, right? If you live in a 4-family and there's a 3-family right next door and you want to tell the FHA underwriter, or we're trying to paint the picture that the homeowner wants to live in a 3-family as a primary residence, they might think that they're just trying to buy an investment property and use the minimum down payment program to do it. It would have to be that the 4-family's run down, it's filled with Section 8 tenants, where the 3-family is brand spanking new. Everything was built from the ground up. It's a new construction, and it's going to be, you know, your family members living in there as opposed to tenants.
Okay.
One can make an argument, right? But they look at it like on a case-by-case scenario. I had a lady that went from a single family, 3-bed, 2-bath, to a 2-family. And at first I got pushed back from the underwriter. I said, hold on a second. Look at the documents that I submitted. She's in a small 1-family house in Southside Jamaica, Queens. She's not going to a 2-family in the suburbs of Long Island in a very upscale neighborhood where the schools are 10 times better and crime rates are 10 times less. And the second unit is not even going to be for a 10, it's going to be her daughter. She's a single mom with a little 6-year-old girl. When the underwriter looked at the bigger picture, she was like, yeah, you're right. I can see why this lady's go from a 1-family with no tenants to a 2-family with her daughter being her tenant or whatever the case may be. So it just has to make sense. And it's all about how we structure the loan. But Rocky, to your point, if it's literally right next door, it's going to be a hard pill to swallow. Although I did close a file early, it's like January, February of 2022, where the buyer went from a really, really crappy, rundown 2-family house on the same block. And not his next door neighbor, but 4 houses down, the guy was selling his house and it was built in 2010. So it's, 12 years old and it's bigger and it has a front yard and a backyard. My buyer's house where he lived, he owned, didn't have a front yard, just a backyard. So the underwriter approved that file, and he went from a 2-family to a 2-family. But it made sense. As long as it makes sense, the underwriter will approve it.
So again, you could refinance your 4-family, get that FHA off the table, get a 3-family for FHA. Now, when you're going to a 2-family, John,
Yeah.
And so now you're going to a 2-family. So let me ask you a question. This is kind of something that just came to my head. So I got a 3-family with a FHA. I refinance that. Can I go back to a 4-family again with the FHA?
You listen, you can, as long as you always prove and it makes sense that you're going to be moving into the property as your primary residence, right? If you go from a 3-family to a 4-family, you want to use FHA. Why? Better neighborhood, better schools, lower crime, closer to your job even. I had a guy that bought a huge 1-family house in Long Island in a really nice neighborhood, but he's a Con Edison worker. He works in Manhattan all day long, 12 hours a day. And the commute to his 1-family house in Long Beach, and Long Beach is one of those neighborhoods, guys, I don't know if you've been there. Long Beach is not like right off the highway. It's like off the highway and another half hour of driving, like through the back streets. It's really far and it's kind of like hard to get to. So he found a 2-family in Brooklyn, a brownstone. So he went from a 1-family to a 2-family. And his story is that he wanted to be closer to his job. He was sick of commuting and FHA approved it. Boom, he closed.
So again, you could build a story to that, right? So it still aligns with what we have to do, guys. And this is where we said, know the guidelines, know what you have to kind of follow. And this is where you go from a 4 to the 3. If you want to go to a 2, you can. You have to build a story. You can refinance those other 2. Because you're going to build equity after 1 year and still buy a FHA. And then if you're going to go for a single family, you heard it from John, go to a conventional with a 3% down. He got those programs already lined up, right, John?
Yeah.
Okay, awesome.
I got it.
So again, this is how you could do it with a minimum payment down and getting the right people around you guys. I do want to wrap up. I don't want to make this long, but John, this has been incredible for you to step in.
Rami,
really good.
So remember, guys, minimum down payment on any FHA transaction is 3.5%. Maximum seller concession on any FHA transaction is 6%. Remember the minimums and the maximums. 2-family don't have any restrictions. You don't need reserve, no self-sufficiency. Those 2 things only apply to 3 and 4 units.
Good to know.
Awesome. Yeah, that's awesome because we're now where when you're thinking about mortgages, we only have this one blindfold. I'm going to go buy me a 2-family house or 3 because of XYZ. But I really think, but from my point of view, when you get a 4-family, you get 25% divided, 3-family, 33% divided. We're not talking about the basement if you want to live in there. At a 2-family, you got it 50% divided. So we're making sure that you could build wealth and cover everything of your expenses too as well. So John, we're going to have your information below, but I would love to give your website as well as your somebody who's listening right now on the car, as well as your phone number that could reach you and your team. But we're going to have your information below so that they could contact you directly. And you are also licensed in many different states.
Yeah.
So go ahead, John. Why don't you go ahead and say the last words? I will thank you for today.
Yep.
No, listen, thank you. It was an honor to be on your podcast. Thank you for giving me the time to speak to you guys. I have a lot to share. Maybe on another podcast in the future, I can share some other information, some other tips. Don't forget about the 2-1 buy down program. It's a powerful tool. I think, did I send you guys the buy down calculator?
Yes, we have it.
Yes, you did. Yep.
Yeah, so use it or be like, hey, John, can you send me a buy down calculator for this house I'm going to show on Saturday? Send me the MLS number. Send it to the Team John group chat. And I will send back an FHA and a conventional buy down calculator. So if the buyer's like, oh my God, that's the mortgage payment. They're like, no. That's your mortgage payment with the current rate. But with the 2-1 buy down, this is your mortgage payment, $900 cheaper. And year number 2, $400 cheaper. Year number 3, don't worry about it. We're going to refinance. So don't forget, 2-1 buy down program. Don't forget about the FHA stuff I told you about. The different states we're licensed in. And I'm working this weekend all day. I'm working Sunday. So anything comes along, call me, text me. I'll help you guys out anytime you need me.
And I want to say the last word. John has an incredible, these guys, I'm sorry, ladies. I'm gonna get
all ladies too.
Ladies at the back end. They're incredible.
They're all superwomen.
They're on point. They don't miss a beat. And like I said, kudos to you, brother. I'm happy that I met you. Our team, Never Give Up podcast, is happy that you're here. We're all going to bring you back. We're going to be focusing on building wealth for other generations to come. All right, guys. Thank you so much. We'll run out.
Bye, guys.
Road to 1,000.
See you.